Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I would like to share my stock, ETF, and mutual fund portfolio with you and explain how I arrived at it, including the history that helped me determine what I want to invest in. You can always look at my detailed portfolio and net worth updated monthly on www.canadianmoneytalk.ca, link in the description, and I will give you a rundown and reasoning behind my portfolio later in the video. First, a disclaimer. My portfolio is designed for me and my financial goals, and you should arrive at your own portfolio by determining your ideal asset allocation that is right for you. So let's start with the basics of asset allocation and how to structure your portfolio. So asset allocation means how a portfolio is divided between stocks, bonds, and other assets, as well as the types of stocks. Asset allocation is the most important factor in portfolio returns. It's the ingredient in the recipe to achieve your goals. What you want to do is establish a target asset allocation of cash, fixed income, meaning bonds, and equities, meaning stocks, to meet your investment mandate. It is used to meet the investment objectives, and you need to match your portfolio to your personality. So let's look at some factors that will determine your risk allocation. The first is your risk profile, which just means the ability to handle volatility, the ups and down movement of investment value. One part of that is risk tolerance. Are you able to handle the volatility psychologically? Will you freak out when you see a statement with losses and then you can't sleep at night? Second part of your risk profile is your risk capacity. Are you able to handle the fluctuations and the ups and downs financially? Are you selling assets that just dropped in value to buy groceries? Do you have other sources of income to be able to handle downturns? And the third part of your risk profile is your financial education, which increases the amount of risk a person is able to handle. So your know your client KYC consists of your risk profile, which I just talked about, the time frame when you need the money back, and the return needed. So the risk, the time frame, and the needed return drives what kind of a portfolio you choose. Keep in mind volatility and return are correlated. So if you need a large return to meet your goals, you will have to stomach more ups and downs and take more risks than if you needed a small percentage return. Time frame is important because if you need the money back soon, you can't have money in something risky. You could get unlucky and need to pull the money out after a pullback. Stocks need at least 5 years, preferably 10. And as the time nears, you need to rotate out of stocks and into something safer. Stocks are generally more volatile than other assets, with closer to home stocks thought to be less volatile. So it goes Canadian stocks, then US stocks, followed by international stocks, and increasing in volatility. Larger companies and their stocks are less volatile than small company stocks. Bonds or loans are generally less volatile than stocks. Once you decided on what your portfolio will be composed of based on your risk profile, the time frame you have, and the return you need to meet your goals, you'll have, for example, 60% in stocks and 40% in bonds. And then every 6 to 12 months, you will want to see how the portfolio has moved. And if it is no longer 60-40, you'll need to rebalance it back to your risk profile and to buy low and sell high within your portfolio. Now, in my own portfolio, I had the following goals and guidelines. Please go through the same exercise that I did. So primarily, I never want to work 9 to 5 again, so I need passive income from my portfolio. Second thing I was looking for is to be tax efficient. A large majority of my assets are in non-registered or cash accounts and need to be taxed in a low way. Because I have a long time frame, I can have riskier and more volatile assets, and I do want growth in my portfolio. Although I had done very well in US real estate and had it appreciate 200 to 300%, having bought properties in the US right after their financial crisis in 2009, I bought the 4 properties for cash, and so they didn't have any leverage, which is the multiplier produced by putting 20% down and borrowing the rest. Therefore, I had low cash flow returns. Also, the properties were risky because the US is quite litigious, and overall, they were a hassle despite being professionally managed by property managers in the US. I only want to live in real estate at this point and definitely don't want to manage a rental. I believe there will be a growth in emerging markets like Thailand and Cambodia due to a young and growing population. And so I want to make sure that I invest there. And I've done a video on this previously, so you can take a look. So here is my own asset allocation. Once again, this is what works for me, and it's not intended for anyone else. So first we have the single stock Canadian dividend payers to the tune of about 2.7 million, and it's almost half of my portfolio. These are individual stocks that are getting me a 4% or more yield, and this is how I buy groceries. This also guarantees me that goal of no more 9 to 5 work, and it pays Canadian eligible dividends, so they are very tax efficient, up until about $120,000 per year of income. Next, we have single stock US growth. So that's a little bit over $500,000, or about 10% of my portfolio. These are growth stocks with no dividends because foreign dividends are taxed heavily. So here I'm looking for capital gains, which are taxed at half of what the salary or interest would be taxed at. Then we have growth mutual funds and exchange traded funds, about 1.4 million and a quarter of the portfolio. So this is where I am targeting the emerging markets, which I would have difficulty researching, and I want expert active management via mutual funds. These are mostly growth, again paying next to no dividends, and so they are tax efficient in my non-registered accounts. Then we have real estate for about 662,000 and almost 12% of my portfolio. This is primary residence, and then there's about 100,000 in tax credits from the sold off US properties where I prepaid US taxes. I am at this point trying to have as little money in primary residence as possible, since it's not an investment, and I'm definitely not wanting to have any more rental properties. So this has been my choice of how to allocate my money. And then finally, we have private equity, which are private investments for about $250,000, or about 4.5%. It is a nice diversification from stocks because these investments don't move very much, but they are also the riskiest because they don't have to have much in disclosures, and they can go wrong fairly frequently. So they're a nice diversification, but risky. So I hope this gives you a better idea of how to use your financial goals and constraints to better choose your portfolio. Once again, this is available in detail and updated monthly on www.canadianmoneytalk.ca. I hope you found this interesting. Feel free to ask questions in the comments, and remember, you need to create a portfolio that works for you, not for anyone else. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.